Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at EOS Energy.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Because today we're looking at a truly wild moment in the market. I mean, we're talking about a stock that has just been absolutely punished over the last 6 months.
Oh, totally hammered. I mean, EOS Energy, ticker EOSE, was basically ground down to a 52-week low of like $4.05 just days ago.
Yeah, the chart looked incredibly grim.
Right, just brutal. And then, out of nowhere, on July 15, 2026, during the aftermarket session, it just exploded upward.
Surged almost 12%.
Exactly. It touched $4.89 in a matter of hours. So our mission today is to figure out exactly what is happening under the hood here.
Yeah, because they're reporting record revenues and this massive influx of shipments.
But the real question is that actually enough to fuel a hyper-growth turnaround? Or is the market just getting hyped up on preliminary numbers and, well, setting investors up for a trap?
It is the defining question for this stock right now. And frankly, trying to track a 12% after-hours swing on a stock that was sitting at a yearly low, it can be really confusing if you don't have the right visuals.
Oh, for sure. It's just noise without the right tools.
Exactly. So before we get into the mechanics of this move, I want to mention a really useful tool for investors and traders who are trying to make sense of this kind of price action.
Yeah, tell us about it.
If you want help reading trading charts more clearly, you can check out VIP Algos through the link below in the description. VIP Algos is it's a TradingView indicator suite.
Nice.
Yeah, it overlays visual buy and sell chart alerts directly onto your screen. It gives you trend direction tools, maps out support and resistance zones, and it even highlights those TPSL, take profit and stop loss planning areas.
Which is super helpful. And it works on different markets, right?
Yep. It works across stocks, Forex, crypto, gold, indices, whatever you're looking at. It basically just cleans up the noise. But keeping safety and compliance in mind, remember that VIP Algos is purely an educational chart analysis tool.
Right. It's not financial advice.
Exactly. Not financial advice. It definitely does not place trades for you, and it cannot guarantee profits. Trading always involves risk, so you have to manage your own risk and do your own research.
Always.
Also, the link below is an affiliate link, meaning we may earn a commission if you use it at absolutely no extra cost to you.
All right, let's move into the wealth building context here. How does a highly volatile stock like EOS Energy even fit into a long-term portfolio strategy?
Well, it's definitely not your safe harbor.
Right. When you're building wealth, you typically have your foundational layers, your broad index funds, the steady blue chip dividend payers.
EOS Energy is the exact opposite of that.
Literally the opposite. This belongs strictly in the high-risk, high-reward, speculative turnaround bucket.
Yeah, because they operate in the domestic energy storage sector. Which is fascinating, really, because they're trying to capture two of the most massive secular trends happening globally right now.
Grid stability and domestic energy independence, right?
Exactly. Those two trends are entirely reshaping infrastructure capital. I mean, think about the physical electrical grid in the United States.
It's old.
It's old, it's fragile, and we're currently flooding it with intermittent renewable energy.
That's solar and wind.
Right. We're adding immense amounts of solar and wind power. But the fundamental problem is you can't control when they generate electricity. The wind doesn't always blow when demand is highest.
And solar production drops off right when people get home from work and, crank up their air conditioning.
Exactly. So we have this sudden, desperate structural need to store that energy at a massive scale so it can be deployed later in the evening.
Right. And lawmakers are realizing we can't rely on foreign supply chains for this. It needs to be built with technology sourced and manufactured right here in the U.S.
Yep. Domestic security is key.
Okay, I get the broader sector tailwinds, but, a rising tide doesn't necessarily lift a sinking ship. Turnaround plays like this are notorious for trapping retail investors.
Oh, absolutely. The classic value trap.
Right. You see a stock that is down over 60% year to date. It looks cheap. You think you're getting a bargain, but it just keeps bleeding out because the business model is broken.
Yeah, it happens all the time.
So I have to ask, is this 12% pop a genuine structural shift for the company or just a temporary dead cat bounce driven by hype?
Well, to figure out if it's a trap, you have to look right at their fundamental technology. That's their competitive mode.
Okay, what makes them different?
EOS isn't just making generic batteries. Their entire business is built around their proprietary ZNYM battery technology.
ZNYM?
Yeah, it stands for zinc. It's a zinc-based system, which is fundamentally different from the lithium-ion batteries in your smartphone or electric vehicles. And the critical differentiator here is that these zinc batteries are non-flammable.
Oh, wow. Which is an absolute game changer for utility scale storage.
Exactly.
Because with lithium ion, you have the risk of thermal runaway.
Right, thermal runaway.
If one cell gets damaged, it ignites, superheats the next one, and you get this unstoppable chemical fire. If you're a city planner, the last thing you want is a giant facility full of potential chemical fire bombs next to a neighborhood.
Precisely. The safety profile of zinc fundamentally changes where you can place these facilities. EOSE batteries are practically custom-built for urban environments where safety regulations are strict.
That makes a lot of sense.
And they're optimized specifically for what the industry calls 3-hour duration peak shaving.
Meaning they discharge their stored energy steadily over that exact 3-hour window in the late afternoon when the grid is most stressed.
You got it. Purpose-built for the grid's biggest pain point.
Yeah.
And going back to the moat, they manufacture these entirely in the U.S.
Which means IRA tax credit eligibility.
Yep, Inflation Reduction Act credits. Plus, it insulates them from overseas supply chain disruptions.
Okay, so the product logic is sound, the moat is there, and the market is responding because the preliminary Q2 2026 revenue is expected to hit a record $68 to $69 million.
Driven by a threefold increase in actual unit shipments.
That's huge.
Yeah.
And their trailing 12-month revenue growth is sitting at an astronomical 725.76%.
It's explosive hypergrowth.
But hypergrowth is expensive. They're burning cash, right?
Yeah. Oh, they are bleeding capital. You can't just look at revenue. The balance sheet shows how they're surviving. They just got a $75 million equity injection directly from Hudson Bay Capital Management.
Wow, okay.
And in total, they're anticipating about $375 million in equity investment. But how they're using it is fascinating. A massive portion is funding their Frontier Power USA joint venture.
Wait, hold on. Let me make sure I understand this. They are taking their own investment capital to fund a joint venture.
Yes.
So the joint venture can turn around and buy EOSE batteries. Why fund your own customer?
It sounds strange, I know, but it's brilliant financial engineering. By funding Frontier Power USA, they're creating a captive pipeline of projects. Developing energy infrastructure takes years. Land, permits, grid agreements, it's friction.
Right.
By having a JV handle development, EOSE guarantees that whenever a project is ready, EOSE batteries are the ones being bought. They don't have to hunt for buyers while trying to scale.
Okay, that's clever. But that brings us to the catch. The margins. Right now, this company is losing a staggering amount of money.
Terrifying amounts on a spreadsheet.
Their trailing 12-month gross margin is negative 101.88%. For Q2 alone, the gross margin loss is somewhere between 69 and 73%.
Yeah, that's rough.
Just in plain English for you listening, for every dollar of product EOSE sells, it costs them roughly $1.70 to manufacture it. Losing 70 cents on every dollar is a fast track to bankruptcy.
It is, but you have to view it through the lens of manufacturing mechanics. This isn't software, it's heavy manufacturing.
Right. It's like building a massive, highly automated, billion-dollar car factory.
Exactly.
I have this incredible facility. You pay property taxes, salaries, robotics, overhead. If you only produce one car the first month, technically that one car costs $10 million to make.
Because of the fixed overhead.
Right. But if you ramp up and produce 10,000 cars the next month, the overhead is spread out and suddenly you're profitable.
And EOSE is currently at the absolute trough of the manufacturing ramp for their new Zenith production line.
The fixed costs are eating them alive because the volume isn't high enough yet.
Yep. They are racing to scale fast enough to absorb that fixed overhead. Which brings us to the catalyst timeline, because the entire investment community is watching that Zenith line.
So what are the near-term triggers?
The full Q2 earnings report is imminent. Institutional investors want forward guidance on those margin improvements. If management proves the unit economics are flipping positive, it rewrites the company's valuation.
We also have the recent completion of a rights offering.
Yeah.
Which, dilutes shares, but it removes a massive overhang because the market finally knows how much cash they raised. Plus, we're waiting for more of those Frontier Power USA projects to convert.
But there's also a massive geopolitical macro tailwind right now.
Oh, the U.S.-Iran conflict.
Exactly. It's July 2026, and the severe escalation has resulted in the closure of the Strait of Hormuz.
Wow. Which is arguably the most critical energy choke point on the planet. I mean, a massive percentage of the world's oil and LNG passes through there.
Right. And when it closes, it sends an absolute shock to the global economic system. It forces nations to rethink national security.
So domestic independent grid resilience isn't just an environmental talking point anymore. It's critical national defense.
Precisely. You have to keep the lights on without imported fuel. That makes EOS, using domestic zinc instead of imported lithium, entirely manufactured in the U.S., a highly strategic asset.
That's a massive tailwind. But playing devil's advocate here, with the stock already popping 12% after hours on the preliminary data, are these catalysts already priced in at $4.89? Or is the market just waking up to this?
To see what's priced in, we have to pivot to the chart. The technicals show brutal, relentless selling pressure, down 61.87% year to date.
Right, it was in free fall.
It finally hit that 52-week low of $4.05 on July 13th. But then we saw this violent reversal on July 15th, up to $4.89.
That divergence is huge.
In technical analysis, violently rejecting a low like that often indicates a bottoming structure, a capitulation event.
So capitulation is basically when the last terrified sellers just throw their hands up, sell at whatever price to stop the pain, and exit entirely.
Yes, and volume confirms it. This wasn't a quiet bump. Volume is running at 1.09 times its 3-month average. We're looking at a 10-day average volume of 27.3 million shares.
Wait, 27 million shares?
Yeah.
Does that massive volume at the absolute lows usually mean the weak hands have finally folded, allowing a base to build?
Exactly. It's a massive transfer of ownership from panic sellers to high-conviction buyers. And we actually know who some of those buyers are.
Oh, really?
Yeah. The squeeze watch indicator flagged significant net insider buying. Over the last 90 days, insiders bought a net 22,926 shares. 25 buy transactions versus 26 sells.
Wow. When executives use their own money to buy at a 52-week low, that's a massive signal.
It means they believe the zenith line is succeeding.
Which brings us to sentiment. Surprisingly, Wall Street is pretty bullish. Truist Securities initiated a buy rating with a $7 price target.
And Stifel maintained a buy. They lowered their target slightly to $10, but that still implies over 100% upside.
That's significant institutional backing, and the narrative is catching fire with Frontier Power USA selecting real projects like Wildfire BES and Stella Energy.
It proves the captive pipeline works. But there's also a speculative angle. EOS has a remarkably high beta of 2.66.
So it's hyperreactive. For the listener, a beta of 2.66 means this stock moves nearly 3 times as violently as the broader market.
Right. Combine that extreme volatility with heavy volume, and it's a powder keg. If management guides margin expansion on the next call, it could easily trigger a short squeeze.
Shorts would be trapped, forced to buy at higher prices, driving it even higher.
Exactly. But honestly, Hudson Bay's $75 million check is the ultimate market vote of confidence. That institutional money overrides retail fear.
True, but we have to be balanced here. Turnarounds are incredibly dangerous. Let's talk about the risks, specifically the execution risk, which is just monumental.
It's the single point of failure. The bullish thesis lives and dies on the zenith line's ability to scale.
Because losing 69 to 73% on gross margins means they're literally losing money on every unit sold. If they hit a supply chain snag or the robotics fail, and they can't reduce unit costs.
The financial math just collapses.
And closely tied to that is the relentless dilution risk. Growing physical manufacturing burns cash.
Fast.
Existing shareholders are taking the hit. We saw the rights offering 27.36 million units at $5.48, plus the Hudson Bay deal.
Growth comes at a cost, and it's dilution.
And look at the severe cash burn. A trailing 12-month net margin of negative 296.13%. That is a tightrope. If execution stumbles even slightly, further dilution will completely crush this current stock price.
It's a very precarious setup.
So with all the fundamental tech advantages, the macro tailwinds, and the severe execution risks on the table, what's the final verdict?
Well, synthesizing everything, we're looking at a bullish score of 7 out of 10.
Okay, 7 out of 10.
But with a specific horizon. We define the target horizon as a swing trade into the Q2 earnings and FPUSA project conversions, so roughly 3 to 6 months.
Got it. So the elevator pitch is, this is an asymmetric upside, speculative turnaround play, fueled by hypergrowth and geopolitical tailwinds, but heavily tempered by severe execution risk on manufacturing margins.
That sums it up perfectly.
And just a quick reminder, this is strictly an analysis of the data, not financial advice to buy, sell, or hold.
Right. But it does leave us with a provocative thought to cheer on.
Oh.
If domestic energy security and non-flammable grid storage truly become a matter of critical national defense because of the Middle East conflict.
Right, the Strait of Hormuz closure.
Exactly. Could a company like EOS Energy with proprietary tech and a fully domestic supply chain become a prime acquisition target?
Oh, wow.
Right. I mean, could a legacy defense or energy giant just decide it's easier to buy them outright rather than build it themselves?
That is a massive question to keep an eye on over the coming months.
Yeah.
And as you watch EOS Energy's chart to see how this plays out, if you want a cleaner way to visualize it, you can check out VIP Algos. The link is below in the description.
It's a great tool.
It really is. It's a TradingView suite with visual buy and sell alerts, trend tools, and TPSL planning areas. Just remember the rules. It's strictly an educational tool, not financial advice. It doesn't place trades, and there are no guaranteed results. Trading involves risk, and that is an affiliate link, so we may earn a commission.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.